So the Fed has left the door open on whether it will hike rates in June. Given the backdrop of slowing growth, high inflation, and credit tightening, how does Franklin Templeton see the Fed moving on rates? And how does this uncertainty impact the way investors should be looking forward in terms of tech investing?
Good question. So Franklin's a very big place with multiple views on what's going to happen with inflation and rates and ultimately central bank policy. In our group, we believe we are closer to the end of the rate cycle than the beginning. If that is true, then we believe we're going to be operating at least in a stable rate environment. That should be positive for in getting investors to come back into duration assets, in particular growth technology businesses. However, if the Fed has to pivot, i.e. because of the reasons you outlined, tighter in credit environment, calming inflation, and a weakening growth environment, then we think that there's actually some positives to be thinking about. So if they started to cut rates, that could be very positive for duration assets. We estimate for the index we use on the fund, if the 10-year were to come down by 50 basis points, that would increase the terminal multiple on our index by 10 to 15%. If the 10-year were to come down by 100 basis points, that would increase the terminal multiple we use for our index by 20 to 30%. So in a policy pivot scenario, that would be very positive for duration assets and in particular growth technology businesses. We are betting on, or we are really in the camp that the Fed can just pause, and even that will be positive. It will invite investors back into the sector.
So there has been an indiscriminate sell-down of tech stocks in much of 2022. So do you think there are still opportunities in the tech sector? And how should investors seek out these opportunities today?
Yeah, good question. So certainly there was some indiscriminate selling over the period you described, but much of the sell down made sense to us. And it really happened for two reasons. One, the Fed was raising rates in response to inflation that compressed terminal multiples. We went from an environment of free money to money having a cost. And so there was an impact on multiples in the sector. But we also saw we came off of a period of significant technology acceleration as a result of COVID. And so when the world reopened, we saw a lot of those trends in e-commerce, in gaming, in PCs, and even mobile phones start to slow, and then we went into a digestion cycle. Now, we think we are, again, closer to the end of the rate cycle. We are through a lot of the negative estimate revisions, and we think that will be positive for a return to growth in the sector. You always want to be thinking about owning quality businesses that have excellent growth prospects and that are trading at discounts to their intrinsic value. So on the quality front, we're looking for high quality business models, companies with some sustainable unfair competitive advantage, some moat, strong management teams that can execute in a variety of different environments, and high efficiency, either evidenced by good profitability or very efficient metrics with regards to how they bring on new sources of revenue. We also want to own well-capitalized businesses, companies that have strong balance sheets, and of course you want to own companies that are number one or two in their market. So that's on the quality front. On growth, you're looking for businesses that are operating in very large markets and that can stack together multiple S-curves across different products that all build on one another and or multiple geographies that will allow that growth to sustain for a very long time. And then finally, on a valuation perspective, you want to make certain you're buying these businesses with a margin of safety, i.e. businesses that are trading at discounts to their intrinsic value. And so we seek to understand that by building multi-year discounted cash flow models aimed at helping us understand what these businesses might be worth in a variety of different scenarios. So you want to be looking at the quality of the businesses, the long-term growth potential of the businesses, and then ultimately whether you're paying a good price for them, so a fair valuation.
Speaking specifically on the FAANG segment, what are the key risks and opportunities in the big tech segment that the investors should be looking out for?
Yeah, Good question. So many of the big tech names have done well year to date because investors are nervous about the rate and pace of the global economy, about where rates are headed. And so we have seen some crowding or some enthusiasm for some of the big tech names here year to date. Many of them have done quite well. Part of that is happening, we believe, because these companies are structural growers. Certainly they are very high quality businesses with high levels of profitability, good balance sheets, platform-like business models, and their valuations are reasonable to attractive. However, if we get into a period of a policy pivot, we could see investors in the tech space seek to move away a bit on the margin from some of these big tech names into more of the small and mid-cap tech names, which I think would be quite positive for many of the names that we own in our strategy. Certainly we are happy to own names like Google, Microsoft, Apple, even Nvidia in the portfolio. But again, in the face of a policy pivot or more confidence about the economic outlook, that would be positive, we believe, for some of the small and mid-cap names. And that would potentially come at the expense a bit on the margin for some of the big tech names that have performed so well year to date.
Do you think that these companies, the small and mid-cap companies, are able to pull ahead of their larger peers in terms of growth? And if so, what are the specific factors, such as niche tech segmentation or cash position, that investors should be looking out for to uncover these gems?
Yeah, well, so certainly we own, again, many of the big tech names that have had a good run here year to date, but we are underweight big cap tech, and we are overweight small and mid-cap tech, primarily because we think those companies have better long-term growth prospects, and we believe that we have a team and a process that allows us to uncover some of the best opportunities. So again, back to one of my earlier questions, we really need to be, investors need to be thinking about the quality of these businesses, the good growth potential, and whether these businesses are trading at good discounts to intrinsic value. And we think, particularly in small and mid-cap tech, that many of these businesses have the quality dynamics. Certainly they have excellent growth prospects and are still trading at very attractive valuation levels given their long-term growth prospects.
So given the recent improvements in AI or artificial intelligence, as seen in the fervent discussions over ChatGPT, what do you think about this technology? And also, to more extent, what are the opportunities and risks in AI investing?
Yeah, well, certainly we are very excited about what we're seeing with artificial intelligence broadly, but even more specifically in generative AI. Just as a reminder, artificial intelligence has been a mainstay of the technology sector for many years now. Many of the big internet companies have made heavy use of the technology. Tesla's made heavy use of the technology, but oftentimes for back-end systems work. With the generative AI technologies around language and around content generation, we are starting to see these technologies come out to the front-end user, or right to the end user. And we think that that is going to be very, very exciting. I think many of us have been dazzled by what these models are capable of doing. When you go to their website, you get them to generate your homework, or write a funny limerick, or write a poem, or generate some interesting picture. But these models now are starting to be incorporated directly into the productivity tools that hundreds of millions of knowledge workers across office work, across software development, and even media generation use every day. And when these models get integrated into these tools, where there are literally hundreds of millions of workers using them over the next few months, we think it's going to unleash a lot of productivity. And the companies that are able to charge for those productivity gains, we think are going to do quite well. Names like a Microsoft or an Adobe that have strong monetization models around generative AI are going to do well. But then this is going to put increased demands on the semiconductor layer. So Nvidia, that sells the GPUs that are critical for this, or firms like TSMC that do the fabrication of these advanced chips, where these models are either trained on or inferenced on, are going to do well. And then certainly the cloud computing vendors that oftentimes are hosting the data and hosting the compute infrastructure where the learning and the inferencing are done are going to do quite well. And then finally, many infrastructure software companies can benefit from this opportunity, and the application software companies, many of which we own, can do quite well. These companies that have large compounding data sets that they can learn from and ultimately make their users more productive and charge a fee for that, we think are going to do very, very well on the back of generative AI. I would just want to leave your viewers with 3 things to think about. First, we think there's tremendous growth prospects ahead for the sector on the back of this multi-trillion-dollar opportunity we see for digital transformation and the 10 sub-themes that we've identified, 2 of which we think are profoundly misunderstood by investors at this point. First is cloud computing, a multi-trillion-dollar opportunity on its own right that we think is soon going to stabilize, and then as the economy improves, start to reaccelerate. And then secondly, generative AI, a big opportunity there that will only get bigger as these models are put into the productivity tools that knowledge workers, software developers, and content creators use every day. Second point is that we think we are closer to the end of the rate cycle than the beginning. This should be supportive for valuation multiples. If rates were to come down, we would actually see multiples in the sector potentially go up. That would be positive. And finally, tech is already in the middle of its own recession in this post-COVID digestion period. That is positive because the negative estimate revisions that we've seen over the past many quarters now are soon going to come to an end, and ultimately that will create stability on which will invite investors back into the sector.
All right. Thank you very much, Jonathan. It's great to have you today.
Great.